Good evening, everyone. Thank you for joining us today. I am Meena Rupani from Trust Mutual Fund. Today we have with us Mr. Mihir Vora, Chief Investment Officer. Mihir has over 3 decades of experience in investment management across various asset classes, including equity, fixed income, real estate, and alternate investment funds. He formerly worked as Senior Director and CIO for Max Life Insurance, where he oversaw 1.3 lakh crores in AUM. He has worked with other significant institutions like Abu Dhabi Investment Advisory, HSBC Mutual Fund, IPRU Mutual Fund, SBI Mutual Fund, and others. Along with him, we have Mr. Aakash Manghani, Fund Manager Equities. Akash has over 15 years of experience in areas of equity research and portfolio management. He formerly worked with as a fund manager at ICICI Prudential Life Insurance, where he managed 7,000 crores of AUM. His previous stints included fund management at Boy Mutual Fund and research at PINC and Grid Capital. Mihir and Akash will take us through the presentation followed by Q&A. Participants are requested to post their questions in the Q&A section. Without taking much of your time, I'll hand it over to Mihir sir. Mihir sir, over to you. Thank you.
Thank you, Meena. Welcome, everybody. Thanks for joining us on this lovely July afternoon. Always a pleasure to have our partners join us. So first of all, again, thank you. A lot of you have participated with us in our first equity fund NFO. So while we were there in the fixed income funds for a long period of time, in April, we launched our first equity new fund offering, the Trust FlexiCap Fund, and we met with very enthusiastic response from investors as well as partners like you. And we collected over 510 crores with more than 16,000 applications and thousands of distributors kind of distributing our products. So considering that it was the first NFO, we are quite happy with the outcome. And in no small proportion, the credit for this good success of the NFO goes to all of you. So thank you so much for this enthusiastic response, and look forward to many more such NFOs, and look forward to your continued participation in our existing funds, both equity funds as well as the fixed income funds. So a lot of you also would have participated in our NFO roadshows, where we discussed our philosophy, the background of the fund house, the background of the promoters, the fund management team, including CIO, fund manager, analysts, and our core investment philosophy. So I'm sure you are all aware of that. But for those of you who may not have participated in some of those presentations that we did on the NFO, I'd probably like to start by summarizing in a very short time, our core investment philosophy. And that also kind of blends or kind of comes from the group background or the promoter's background. So a little bit of that also. So just to remind you, Trust Group basically is promoted by Mr. Utpal Seth and Nipa Seth. Both are experts in their own field. Nipa Seth runs Trust Capital, which is the largest non-bank debt investment banking, broking, placement, syndication house in the country. Very successful. Utpal Seth, of course, is CEO and partner at Rare Enterprises, the family office of Mr. Rakesh Junjunwala, where he's been associated for more than 22 years. So he's an expert, as you all know, in the equity market. So as a group, we have very deep expertise at the promoter level itself in all levels of capital markets, whether it's the fixed income markets or the equity markets. Fund managers, including Akash, myself, Jalpan on the fixed income side, again, we come with very rich, very deep experience. So the overall strength of the investments team is very, is very noteworthy, so to say. All of us come from very experienced backgrounds in asset management. So, a little bit of the promoters, and that's important because very few asset management companies have this kind of a background where the promoters themselves are experts in capital markets. So that kind of stands apart and makes us a bit unique as far as the AMC space is concerned. As far as the philosophy is concerned, very clearly, that again comes through the lineage of people like me, who's CIO, Akash, our fund manager, and the promoters, where we are very, when we are discussing how to set up the AMC and how to set up the equity funds, we were very clear that there's a very deep meeting of minds on the philosophy part or as to what equities in India stands for. So for us, equities, especially Indian equities investing, is all about growth. We are very clearly growth investors with a keen focus on the longer term growth potential. Of course, we look at the shorter term growth potential, but what we are most interested in is the extreme long term growth potential of India and then the new sectors and stocks, etc., which emerge when countries like India emerge from $500 per capita GDP to 1,000 to 1,500 to 2,000 to 2,500 and hopefully to 10,000 by 2047. So when the GDP and the GDP per capita both are growing at a certain level, there are different stages in the life of a country. And at different stages in the life of the country, at the different stages of GDP per capita, different stocks, different sectors, different themes work. So, it's for a developed country like Europe, Japan, things are very stable. The demographics are stable. Most of the sectors are well established, well developed. So, newer segments emerging happens rarely. But for India, because we are so young and growing so rapidly, newer companies, newer business models, newer segments emerge very fast, and that's what basically creates this whole dynamics of growth. And India is one of the very few large markets, large economies in the world now, which is still a democracy, still very open, still very dynamic, still very young in terms of demographics, and that creates this whole magic of long-term growth investing for India. So as a philosophy, we are basically growth investors. We do pay a very keen focus on valuations, but ultimately we would like to see that the earnings growth has to come through, if not in the short term, at least in the long term. So that's one basic fundamental approach that we have been very very convinced about, and that's exactly what we also promise to investors as to the philosophy that we will follow in the longer term. I will I will share a few important slides which we had presented then, just as a recap. So this is what I captured, that investing is in our DNA. We talked about the promoters and the core investment team and the core philosophy. We are very clearly, as you can see, growth investors, growth at reasonable valuations. So as I said, we do pay close attention to valuations, but our North Star, our core philosophy is that of terminal value investing. And this is what actually differentiates normal growth investing versus what we consider as our core investment philosophy of terminal value investing. Essentially, when we talk about terminal value investing, it basically means that in growth markets and growth companies, the value of a stock actually is determined, yes, by the immediate future, but even more disproportionately by the longer term growth rate potential of that. And what typically happens is that investors and fund managers and analysts find it easier to project the shorter term, but find it more difficult to project the longer term growth rate. And that's where we tend to really underestimate the long term growth potential of many stocks and sectors. Essentially, terminal value is the value of the stock price, which comes from the longer term growth potential, say beyond 8-10 years. What will be the growth rate? That's what actually disproportionately influences the current stock price. We always think that the next 2-3 years of earnings is what will drive the stock prices. That drives the stock prices maybe to some extent in the shorter term. But if you look at the longer term potential, if you look at the market, what the market is looking at, then the market actually tends to discount the longer term much more than the shorter term. So if we can find those stocks and sectors where the runway of growth, where the longevity of growth is not 2, 3, 4 years, not a cyclical, but structural, longer term, with a very huge addressable market, then the value of the stock that we can see will be much different from the value that the market is seeing. And that's where we feel the gap is, and that's where we can differentiate in our style of growth investing. So growth at reasonable valuations with terminal value investing as our North Star is basically our core philosophy. And this is exactly what we said in the NFO, and that's how also we have built our portfolio. We had also shared how we differentiate ourselves, so the philosophy versus others. So very quickly, there are pure growth investors who only focus on earnings growth, less focus on valuations. There are price momentum players where only the stock price movement is important. We basically chase the current momentum of the stock price. And then there are very deep value people who look at dividend yield, price to book, low price to earnings, etc., who have their own style, where valuation becomes more the starting point and growth is less important. In our case, we have growth and valuations both equally important, with terminal value as the most attractive proposition for us, where we can find, and as and when we can find, and if we can find stocks with high terminal value, which means high longevity of growth over the longer term, that's where we would like to focus our portfolio on. And you would have seen our marketing material where we talked about gorilla. Basically, companies with high terminal value tend to become gorillas. And what does gorilla mean in the stock market? Basically, in the jungle, and stock market is also one kind of a jungle. In the jungle, there are many monkeys, but there are very few gorillas. In the stock market, there are hundreds of stocks, but there are very few stocks which become long-term multi-baggers. So that's the rarity of the gorilla. They are rare. Second is the companies which have high, terminal value basically tend to become dominant in their field. When they grow fast for so long, they tend to become dominant, large, unchallenged, like gorillas. So that's another characteristics of these kind of compounding stocks, that they tend to dominate the market and then they become large enough. And third is gorillas in the jungle have the longest life of all monkeys, right? And in our case, we are looking at the longest growth path, the runway of growth. The highway of growth is much longer for these companies. So the growth phase lives much longer in the companies which ultimately become gorillas. So that's why in our visuals, in the marketing material, gorilla became so important, because we are trying to spot companies in the stock market which will become, metaphorically speaking, gorillas as far as their position in the industry and stock market is concerned. So, as you all know, we did the allotment on 26th April with the Nifty 500 GRI. We collected around 510 to 515 crores. And as we speak, we are very close to 650 crores. So we have been receiving consistent inflows even after the NFO period, and happy to announce that we've done quite well versus the benchmark, and we've done quite well versus most of the peers. Of course, we're not really looking at 2 months of performance, but it all helps to start on a good note. The NAV is approximately 11.1, so about over 10% return in the past 2 months since we started. So I would like to, for those of you who did participate in the NFOs, I would like to quickly recap what we had kind of indicated or promised during the NFO. We have said that we will focus on our core philosophy of growth at reasonable valuations, GARV, and terminal investing. Happy to say that the portfolio reflects exactly those kind of stocks. We had said that we'll be active managers of the portfolio, which means that we will take bets which are significantly away from the benchmark. That's what we mean by active, not necessarily trading active, but this is how much away, how distant are you from the benchmark, so that you can attempt to generate alpha. Because only if you take bets against the benchmark can you beat the benchmark. So we have taken very active bets. We'll show the portfolio. We had said that we'll be focusing on about 40 to 60 stocks, and we are exactly at 60 stocks. We had also said in April that we will take about 2 to 4 weeks to invest, and happy to say that we invested in 4 weeks. Thankfully, we did not wait for events like the election, etc., and that has served us well because the markets kept on going up. But we did manage to invest well in time, so we invested in 2 to 4 weeks. That's what we had said. We had also said that we will not run as a quasi large cap fund. So because one of the concerns that distributors had was that a lot of the flexi cap funds probably end up being more large cap biased. We said we have no preconceived notions of how we will run the fund. We will go where the maximum growth opportunities are, whether it's in large cap, mid cap, or small cap. And at the time of the NFO, when we had a mental portfolio, paper portfolio in mind, we had indicated that approximately 50% would be large cap, and then 40 to 50% would be mid and small cap. and we are pretty much in line along those lines exactly. And we had said that the themes and sectors that we like are essentially premium consumption, financialization of savings, physical asset creation, domestic economy versus the global facing sectors, and new age companies, new business models. And happy to say that these are exactly the themes that we are overweight on in the portfolio. So pretty much what we had indicated theoretically on paper in the NFO roadshows, we have exactly managed to implement that. So happy to say that there is a true to label mindset that we have, that we will actually deliver what we perform. It's not like just because the market is going in a certain direction, we will change our approach or philosophy. We will invest basically based on our own inherent philosophy and convictions. Uh, so this is where we stand as far as the portfolio is concerned. Is mostly completely invested. 60 stocks, top 3 sectors, 32%, top 10 stocks, about 32%, shows the conviction level, the focus bets that we are taking. Largest stock, of course, is the bank at 5.47% because it is the largest in the benchmark also. Approximately 52% large cap and 44% in mid and small cap, exactly what we had promised, against the benchmark, which is 72% large cap and 28% mid and small cap. So as you can see, we are taking active bets against the benchmark to attempt to generate alpha. These are the top 20 holdings. As you can see, of course, the first 3, 4, 5 holdings will be very familiar names, but then we, of course, have many unique names also, differentiated names also in the portfolio with a significant bias towards physical asset creation, manufacturing in India, those kind of themes as we spoke about. Top 5 large caps, top 5 mid caps, top 5 small caps, as you can see. Good names, decent quality names, but high growth names, most of them. Sectorally, as you can see, when we say we will take active bets, it means that we will take bets against the benchmark. So you can see that we are sharply overweight on a few sectors and we are sharply underweight on a few sectors, basically showing that we are not shirking our kind of approach of taking active bets versus the benchmark, because when you take bets, you win or lose, and hopefully you win more than you lose. That's how alpha is created. So we are essentially overweight on capital goods, automobile auto components, consumer durables, a little bit on healthcare, and we are underweight on oil and gas, financial services, IT. Financial services, structurally, I'm not negative. We are not negative. We would not like to be underweight, but as you can see, when you are more bullish on something else, you have to take money out, and financial services is the largest sector. So when you want to take significant bets in a particular sector, like say capital goods or auto, you need to basically take it out. So we've taken it out from oil and gas, IT, and financial services. But if you ask me my view on banks and NBFCs, I'm not negative. We are positive. So why should you invest in the Trust Flexi Cap Fund? Essentially, I think our investment philosophy of GARV, growth at reasonable valuation, and terminal value is absolutely suited to the Indian conditions, because India is a growth market, and investors can underestimate the long-term potential of high growth stocks and sectors, which is exactly what the terminal value investing approach aims for. So it's quite well suited to hang on and ride the entire long-term potential of India. And as you can see, the background of the group and the investments team gives us differentiated insights. We have probably a different way of looking at stocks and sectors. And this gave us the conviction, patience, and wisdom to capture the full value creation over the short term as well as the long term. And as I said, the focus is absolutely on alpha generation. The portfolio stance, as you can see, we have a good amount of overweight, and this classification is a little different from the other one because we are looking at subsectors now. But essentially, we are overweight on premium consumption, especially the durables and the automotive sectors. Defense, of course, we have almost 7 to 8% weightage. Stocks levered to exports and uptick in local defense manufacturing. capital goods subsectors, like within capital goods, power, the whole entire transmission, generation, and distribution, as well as subsector like smart metering, etc. We have over it on railways, infrastructure creation, real estate beneficiaries, data centers, electronics manufacturing, the entire bunch of capital goods stocks we are over it on. Auto and auto components, of course, on premium consumption for cars as well as two-wheelers. And there are very good auto ancillary stocks in India which are globally competitive, growing very well, not only in the IC engine, but also in the EV space. Healthcare, we are neutral, and IT and financials, as we discussed, including energy, we are underweight on. So that's basically our pitch on the investment philosophy, the portfolio strategy, the portfolio approach. And when we talk about growth investing, I'd like to highlight that if you look at the overall portfolio characteristics, our price to earnings ratio compared to, say, the price to earnings ratio of the Nifty 500 would be a little higher. So if you just look at the PE of the portfolio, maybe it would look higher than the benchmark. But then when you see the growth of our portfolio, the earnings growth, the profit growth of the portfolio companies that we own, that is also significantly higher compared to the benchmark. So we have higher growth as well as a bit of higher valuation. So if you adjust for growth, then the portfolio looks pretty good, which is essentially the whole thing, right? When you talk about terminal value investing, a lot of the value of the stock, valuation of the stock, is because of the far end earnings. And because the market is looking at those longer term earnings, the optical price to earnings ratio for the earnings of this year or compared to the earnings of next year may look a bit higher. But then the rest of the premium, the rest of the value of the company is coming from the continued long-term growth rate for the stocks that we own in the portfolio, which is much higher than what the rest of the index companies. So that's how the PE to growth equation works out in our favor in the portfolio. So that's essentially how the overall approach is. A little bit on the economy and the markets. Globally, we are seeing some slowdown in the US, but it's like a Goldilocks situation where there seems to be a slowdown, but it's not so bad to go into a recession. And when this kind of a slowdown happens, you will see interest rates coming down globally. And the Federal Reserve of the US has already indicated that they will be looking to cut rates in the second half of this year. So the tightness that you're seeing in liquidity, etc., will start easing off in the next few months. So it's kind of a Goldilocks situation where you will see lowering interest rates, which is good, lowering inflation, which is also good, and a situation where compared to the rest of the world, India will continue to grow faster than most of the other countries. So, relatively speaking, India's position actually is becoming stronger and stronger, and the attractiveness of India for FDI and portfolio flows continues to be very high. So, the kind of money that we are expecting both in equity and debt, which we have gotten in the last few years, should continue going forward. So, I'm quite positive because we have good growth, falling interest rates, and most importantly, one of the most stable currencies in the world. The Indian rupee, compared to most developed market as well as emerging market currencies, has been the most stable in the last 1 to 2 years. So when you have this combination of stable currency and good growth, it's a very good combination for global flows to come into the country. So I think the India story continues to be as strong as before, maybe even stronger. We just need to not score self goals. And hopefully there'll be no negative surprises in the budget. In the budget, most of it is a non-event because they don't really tinker around with GST rates in the budget. It's basically decided by the GST Council. Personal taxes, they could tinker around, hopefully make it more simple than before. And they might do something on the F&O front. That's the expectation because FM and SEBI both have been making noises about it. But hopefully it will be in a staggered fashion, in a more prudent fashion. So if there are no such tax-related disruptions, then I think we are in for a good footing. We expect the government to maybe spend a bit more than before on social schemes because I think that's one of the feedbacks probably from the election, that the rural segment is still under a bit of a stress and people do want jobs and support at the lower level because the recovery in the economy post-COVID still has been more skewed towards the higher end consumption, not so much towards the lower end consumption. So I think there might be a little bit of populism in the budget to support the lower income categories. That's the expectation. Apart from that, there's not much, frankly, big bang, hopefully, in the budget that can happen. So as long as we continue on this normal growth path, the markets look okay, and we are positive on equities as well as bonds for India. So that's basically a little bit from my side. And Meena, we can probably open it for Q&A.
Thank you, sir. Thank you for such insight. We have a couple of questions in the Q&A. I'll read it out for you, sir. Mr. Arun wants to know, with much experience in debt funds, would like to know rate cuts in coming days, how equity growth in sync with higher CAGR planned by trust team. As on today, BFSI allocation seems less allocation. Please share your views.
If you're talking about the BFSI allocation to equities, I think I talked about it. Essentially, we are not negative on the BFSI sector. We are positive on the banking and NBFC sectors from the long-term point of view. But it's just that we are more positive on the overweight sectors that we have. So nothing against banks there. We would like to add to that. So when we book profits in some of the stocks that we have kind of done very well for us, we'll probably shift it to something in the NBFC segment. So that's one. As far as rates are concerned, I think India will follow the global cycle. And as I described, we are expecting rate cuts to start from the second half of this year in the US. So once the US gets the lead, I think probably a little bit after that, we should see rate cuts or easing cycle in India also to begin.
Thank you, sir. So there's another question which says, sir, please enlighten us on the IT sector in the present situation.
So IT sector, I think, has become a sector where you need to be more choosy. So in general, the sector, I don't think, is a long-term, very high growth sector if the companies are going to follow a pure IT services, led traditional model, because that's become a commodity. And plain vanilla maintenance services, which is what development maintenance services, which is what been our traditional strength, are not going to grow at 20%. They are going to grow at single digit levels. So companies which have niches, which have differentiated themselves either in terms of service offerings, they are offering something different, or companies which are in the faster growth segments, maybe supporting companies which are in the faster growth segments, for example, say AI or EV, electronic vehicle link sectors, or self-driving kind of situation. Those companies which are able to do something different will grow faster. And most of them happen to be in the mid-cap space. So I think in IT, we are following a more bottom-up approach where broadly we think it's a low-growth sector as far as the large IT companies are concerned. But then within the sector, there are always stocks to choose from. And those are reflected in the portfolio, as you can see. Akash, do you want to add any further insight to some of the picks that we have, not necessarily stock specific, but in general, what we are playing in the mid-cap IT space?
Yeah, thanks. Good evening, guys. So honestly, not much to add. We covered it, but like Mir rightly mentioned, IT services in our country historically, if you look at the last 10 years, 15 years, has grown at 8 to 10%. And given where the scale of some of these companies is, the large cap IT companies, I think growing at 8 to 10% incrementally would be somewhat of a challenge. So most of the large IT companies are growing in the vicinity of 2, 3, 4%. It's the mid-cap IT companies who are differentiating themselves significantly. Companies which are doing turnover in the vicinity of $700, $800 million all the way to $2 billion. The large cap IT companies are doing turnovers well north of $20 billion. These mid-cap IT companies can pivot smartly. They are levered towards high growth sectors, data centers, or AI, ER&D work that happens for automotive clients. So I think they can continue to compound at 15 to 20% in top line for the next couple of years. And then going forward, anyways, the growth trajectory is much higher as compared to traditional IT services. So those are the kind of bets we've taken.
Thank you, Akash. There's also a question on what's our view on small and mid cap? Is market overvalued now?
That's our favorite question these days. So, yes, I would say yes and no, in the sense, if you look at the overall index level and the earnings growth that is expected, there is still scope for the markets to do well. Because at the index levels, if you look at the mid cap index level or the NSE 500 especially, I think there's enough scope for stock picking, because even NSE 500 earnings are likely to grow at a good 15 to 20%, so to say. But there are segments where there is too much speculation happening, especially in the low floating stock segments. A lot of them are in the PSU space, where the government is owning 70, 80, 90% of the stock. And there is very little free float and huge amount of speculation and volumes are happening in these stocks. So I think I would stay away from those pockets. In the themes that we like, for example, also stocks have done very well. So there is less juice left compared to say 6 months ago or 1 year ago. But then what we are doing is we are trying to switch to other stocks where there is much more relative value. So that active churning of the portfolio based on price which has gone below much above what we would expect them to do in a reasonable time frame. So we are kind of trimming and pruning the portfolio and switching to something else. So for example, if we had a target price which was say 50% or 100% higher, we expect the stocks to deliver 50% or 100% in say 2 years. Some of the stocks have delivered 50% in 2 months. So if the 2 year valuation has been achieved in 2 months, then probably we don't mind taking some profits, even though we are still bullish on the long-term growth potential. So we are addressing the issue on a case-to-case basis. But having said that, if you look at our presentation, we have shown that there are approximately 1,000 stocks to choose from, and not all of them are expensive. So there is always scope for stock picking in the mid and small cap space, which is what we are trying to do.
Thank you, Mihir sir. Next question is from Mr. Deepak Garg. He wants to know how learnings from Rare Enterprises and Rakesh Jhunjhunwala ji implemented in the equity funds. Please elaborate.
So as I said, it's basically at the philosophical level. There is nothing at the day-to-day level that is shared or talked about. But as I said, when we fix the fund philosophy of growth at reasonable valuations and terminal value investing, that's basically the DNA of Utpal Seth. And of course, Aakash and I naturally were, maybe when we were in our previous organizations, we did not express it in that way, but essentially both of us genetically or by mindset also are investors, which are basically looking at the long-term growth potential, which we call now as terminal value investing. So I think the influence of the promoters, which is Utpal Seth and Nipa Seth, is at the fund philosophy level, nothing at the day-to-day level.
Great, sir. Sir, Mr. Amit wants to know, we do hold some very heavy valued stocks quoting north of 60, 70, 80 Ps, say Varun Beverages and Dixon, for example. If we have good correction in markets, such stocks may correct heavily. What's your view on such heavily valued stocks?
Sure, Aakash. That's your favorite question, Aakash.
Yeah. So there are a couple of names in the portfolio where the valuations are towards the higher side, 50, 60 P in some cases. So you rightly mentioned the ones that you mentioned are high P. But more importantly, one needs to look at the kind of earnings growth that some of these companies are delivering. So whenever we try and get a stock into the portfolio, our first threshold is to see whether the compounding in the stock can be at least 20-25%. Right? The higher, the better. So most of these stocks in the capital goods or domestic manufacturing or EMS, there the runway for growth is so high that even 5-6 years down the line, the earnings compounding can be well north of 20-25%. For the immediate 2-3 years, the stocks that you mentioned, specifically something in electronic manufacturing, where the sector is just getting created. Prior to COVID, the sector was a very nascent sector. I mean, only in the last 4-5 years, these companies have scaled up revenues. I mean, normally you talk about earnings compounding of 25%. These companies are compounding top line at 40-50%. Right? So when you have such high top line growth, you got to zoom out and think what is the opportunity size? Why is the top line growing at 40-50%? I mean, they today are competing in the global ecosystem. It's just not make in India now; it's make for India and make for the world. And I think we are just scratching the surface in electronic manufacturing. So I think one needs to take a decadal view in some cases and see that, okay, it may be 60, 70, 80 PE, from on the trading earnings basis, but what is it 2 years out? What is it 5 years out? So I think as long as the opportunity size is strong and opportunity size is continuing to expand every year or two, each one the companies in electronic manufacturing, every year or two are getting into new sectors. Like mobile manufacturing wasn't there 3 years back. Out of thin air, I mean, mobile manufacturing got created, and today, Dixon does 10,000 crore of top line mobile manufacturing. That's unheard of, the kind of skill that these companies are blitz scaling, right? So you need to participate in the growth journey, and you'll always get these stocks expensive. So we would have liked to buy them at 30p, 35, 40p, but I think they will be expensive. Are they susceptible to a crash if there is a small mid and small cap crash? Yes, for sure. These are high beta names. Beta is high on the upside as well as on the downside. But I think it's our duty as portfolio managers to control the portfolio risk. So we are not taking undue risk. These stocks are not 5, 6, 7% of my portfolio. So we are managing that at a portfolio level.
And that's just to add to what Akash said, that's exactly what we said. When we are talking about terminal value investing, we believe and the market is believing that these stocks are going to grow for a very long period of time. So they may not grow at 60%, 40, 50%, but they can continue to grow at 20% for a very long period of time. And when you assume that, then the value of the long-term value of the long-term profits of the company beyond, say, 8, 10, 20, 15 years becomes significantly higher. So the market is saying that the companies and in these segments have very long growth pathways. And if you were there in the NFO, we gave the example of one of the leading jewelry manufacturers. The market cap of that company at that point in time is today the profit of that company, the jewelry measure that we talked about. So when you talk about compounding, this is what happens. The profits are by 60 to 100 times in 20 years for that company. So that's how the market looks at growth stocks. That's how the market values stocks where it sees high terminal value, which means a very long pathway runway of growth. Similarly, for defense stocks, Akash talked about electronic manufacturing, where we started from scratch. Even in defense, for example, we are starting from scratch because only PSUs were allowed. Now private sector has come in. The government wants to indigenize what was 80-90% procured from outside. Government wants to make it 80-90% procured indigenously. So that can have again a long runway of growth because we are starting from almost nothing. Indian exports we never used to talk about exports in defense because there was no private sector and government companies anyway were not interested in exports. But from less than 1,000 crores of exports, say 5-7 years ago, in FY24, we exported more than 20,000 crores to various countries in defense. And that's again, 20,000 crores is hardly $3-4 billion. If you say that now the world is your market, then the market can be 50 times bigger or 100 times bigger. So that's and if companies actually get into that segment for exports as well as for indigenous, then the runway of growth can be very high. That's what the market kind of starts to look at.
Thank you, sir. So we have a question on how do you identify gorilla companies in your portfolio and what would be its weight contribution in the current portfolio?
Hopefully, all our companies should be gorillas. But we actually did a kind of a classification, and I would say at this point in time, about out of the 60 companies that we own, probably 15 to 20 companies are where we think the pathway or the runway of growth is very long. Those could be potential gorilla companies. And there's no one way to look at a gorilla company or a potential gorilla company. But broadly speaking, I would say that one of the very important parameters is what is the market for the product, what is the addressable market for that company. And as I said, for example, I just gave the example of defense, where earlier we were not exporting, we are importing, but now we think the export market is a potential. Then the market suddenly becomes not one time, but probably 50 times. So that becomes the total addressable market for that company. And if a few companies in the private and public sector manage to tap into that, then they can grow for very long periods of time. So that's how we kind of approach it.
So in continuation to that, there's another question. Can you be very specific about the number of stocks in very long-term hold category in our existing portfolio, say Gorilla category, out of total 60 stocks?
I think I just answered that.
So another question is, what are the stocks under premium consumption segment?
Number of stocks, if you can refer to the what if you talk about premium consumption, I would say that a lot of the auto sector exposure that we have taps into this. So the portfolio is of course disclosed on the website. You can please take a look at it. But a lot of the auto component, segments that we have, automobile segments stocks that we have cater to premium consumption. So that's one. Most of the consumer discretionary items that we have again are linked to premium consumption. We have a couple of names, for example, in say mutual fund distribution. That is not premium consumption, but the linked theme, which is higher financial savings or higher proportion of savings going into financial assets. So that's a premium consumption plus financialization of savings is basically the theme. So some of the names, for example, in distribution of mutual funds, etc., those would cater to that theme.
Yeah, maybe I'll add over here. Apart from automobiles, we've got a very large, high growth retailer, India's fastest growing retail company, apparel retail. We've got exposure over there. We got exposure to a new IPO company which got listed only about 2 quarters back, which caters to stationery items for kids. Again, something which is slightly on the premium consumption side. So these are the few examples in addition to what Mihir already said.
So there's another question from Mr. Amit. Is what's the PE and ROE of our portfolio on FY25 and 26 basis?
So the price to earnings ratio would be about 33 odd for the portfolio. As I said, it's a little premium to the NSE 500, but then our earnings growth is also far superior. And ROE would be about what 13, 14, Akash?
No, ROE is actually in the vicinity of 16, 17.
60, yeah.
Yeah. So ROE and for the benchmark might be in the region of 15, 16. So ROE is not way higher than the benchmark. Point to note is that a lot of the capital companies that we own, where the earnings are quite suppressed. So ROE is also suppressed. So if you were to look at the forward ROEs 2 years down the line, the numbers would be materially higher than what they are today, because we're expecting very rapid earnings growth in some of these companies in the next 2 to 3 years. There's potential for EBITDA to double in quite a few of these companies between FY24 to FY27. So, yeah.
So Mr. Krish Anand wants to know, is any major correction expected in the future?
Major, I don't know how to define major. Corrections, yes. Major, I don't know. But as long as I think the global situation continues to be what it is, I think we should be fine. There might be some, as I said, cleaning up in some of the F&O link segments with the SEBI and RBI have been talking about, SEBI and Finance Minister have been talking about. So if they take some steps in those segments, you can see some, volatility, and we know that when small caps correct, they don't correct by 2-3%. They correct by 10, 20, 30%, so that can happen from time to time. For example, day before, I think SEBI came out with a list of stocks where basically lending against those stocks will be incrementally more difficult. So basically, it's one more way to try to curb speculation in mid and small cap stocks.
Thank you, Mihir sir. Participants, if you have any further questions, please put it in the Q&A section. Thank you, Mihir sir. We have no further questions. I would like to thank everyone on behalf of Trust Mutual Fund. Thank you for taking out your time and joining us for this insightful presentation. Thank you, Mihir sir. Thank you, Aakash. Look forward for everyone's association, long-term association with us. Thank you. Thank you.
Thank you, everybody. Have a good weekend.